Markets were positive in November, with global equities rising 2%, benefiting from commitments by global central banks to keep monetary policy accommodative and interest rates low for an extended period, and an improving economic backdrop. Eurozone bonds rose 0.4% as the ECB cut interest rates by 25 basis points and suggested further policy measures would be implemented if required. Central banks are as anxious to avoid deflation as they are to avoid high inflation. Deflation causes consumers to postpone purchases and companies to delay investing, and can lead economies into the type of downward spiral which has been evident in Japan over the last 2 decades. In October, Eurozone inflation fell to 0.7% year-on-year, giving rise to fears that Europe might be about to enter a period of deflation, and contributed to the ECB's decision to cut interest rates and to boost growth and protect against deflation. As can be seen in the chart, inflation in the Eurozone has steadily declined over the last couple of years from a high of 3%. Inflation is a backward-looking indicator, and the recent fall is due to a number of issues which should begin to unwind in coming months. Europe has been in recession from the end of 2011 to the second quarter of this year, but growth in the global and European economies is now picking up, which should limit deflationary pressures and contribute to upward pressure in prices in the near term. The euro has strengthened since the middle of 2012 following the ECB's commitment to do whatever was required to save the euro, and this has had the effect of lowering the price of imports. With the Fed set to announce tapering of QE3 in the first quarter, and the ECB suggesting further monetary loosening is possible, the euro should instead begin to weaken through 2014. Global food prices spiked in the middle of 2012 following poor harvests due to droughts, and this led to a significant increase in planting and food supplies in 2013, which has pushed down food prices on a year-on-year basis in recent months. This too should begin to unwind in coming months as the crop supply cycle reverses. Oil prices have been falling as new shale reserves have been developed in the US. The oil price, however, has now fallen to levels where reserves in other parts of the world are close to becoming uncommercial, and thus global supplies could begin to fall and so provide a floor to the oil price. Given these developments, we believe the Eurozone is not about to enter a period of deflation, but instead inflation is likely to pick up to around 1 to 1.5% in coming years, with the November reading already rising to 0.9%, although it will probably remain below the ECB's target of 2%. Central bank actions continue to be key drivers of investment markets. Recently, they have tried to reassure markets that policy will remain accommodative and loose for the foreseeable future, which is positive for the global economy and equity markets. The Bank of England has emphasised that its threshold level of 7% unemployment will not automatically trigger a rise in rates, but will merely lead to a review of whether rates should be changed, and other measures of economic slack will also be considered before a decision is made. The ECB has suggested other policy options are open, including a further reduction in rates, new LTROs to increase liquidity in the financial system, a negative deposit rate which it offers banks to encourage them to increase lending, or possibly even asset purchases as other central banks have been doing. The US Fed is examining ways to convince markets that tapering of QE3 does not result in monetary tightening, and is considering lowering the unemployment threshold of 6.5% for reviewing rates, and possibly announcing a lower inflationary boundary, so that if inflation is below a certain level, it will commit to not raise interest rates. The Bank of Japan is expected to increase its level of monetary stimulus in 2014 to offset the impact of a sales tax increase. Overall, monetary policies are set to remain accommodative and supportive of economies and markets for the foreseeable future. Looking into 2014, we believe equity markets continue to offer upside as growth and monetary policies remain supportive. European bonds, however, could see marginally negative returns as pressure on yields remains to the upside.